Hello everyone, this is Max Russell here, and today's lesson is video tutorial biz is going to be on, a lot of you may have heard the biz on the Goldman Sachs issue. The Goldman Sachs is under speculation right now with the government, and I'm going to show you how that fundamental event is going to decrease the stock price significantly, and how we are going to make millions, hundreds of thousands of dollars, if not millions, profiting off this. So, just a quick little tutorial here about options. We're looking at what's called an option chain right now. The option chain is on the company of the Goldman Sachs Group. COM stands for common stock. Up top, we have the last price, the net change, the bid, the ask, what's known as the bid-ask spread. We have the size, which is how many contracts for each. Right now it's a 3x10, which means that it's leaning towards a sell. It's more of a declining market right now. There is volume is a tricky thing because volume, this is just standard volume. We're not going to be looking at different contract volume right now because that's a whole different subject and that takes a little bit more skill to understand. So right now we're going to be looking at volume. That's the total number of shares traded right now. So it's underperforming at 1.9 million shares right now. And again, on the right-hand side, we have the open, high, and the low. And up there, we have the bid-ask spread as well as the price and the net change. So a quick thing. If those who aren't familiar with an options chain, I'm just going to explain to you what we have here, the different setups we can put, and how they differ from each scenario. So first things first. Actually, let's start from left to right. I think it would be easier if we start from left to right. Okay, so on the left-hand side, where it says October 14, this is the month October. 14 is the year, week 1. 5 days left to expiration, 100 weeklies. These are standard options at 100 weeklies series. Weeklies mean they expire at the end of each week. So, first things first, delta. Delta can be described as the probability of the option expiring in the money, and more importantly, for day trading purposes, it can also be described as the move in the contract in a 1-point move in the underlying, or a $1 move in the underlying. So for every dollar the Goldman Sachs moves up, depending on how many contracts you have, if you buy 10 contracts of Goldman Sachs, that's 1,000 shares. Your contract is going to gain $120 per dollar move in the Goldman Sachs. That's fact. Moving on to gamma. Oh, another thing I should mention about delta. Delta is a strange thing. Delta is what helps, and it is the sole reason on the options I choose to purchase. Because what I do is I purchase, if I'm speculating, I will buy options 2 or 3 strikes out of the money for intraday penetration. Meaning that I would, depending on the delta of the option series, I will buy it. Price doesn't really matter because we're a fully funded account. But anyway, yeah, so depending on the delta, at the money deltas, which have the most extrinsic value, are around 50. For those advanced traders watching this, if you have multiple positions in an option chain, you will learn to do what's called managing your deltas, and I will get into that in another video. That's not for the beginners watching this right now. Number 2 is gamma. Gamma is not very important because gamma is just the change in delta. As you can see, this is quoted in cents, so gamma will be moving 5 cents. Delta will be moving 5 cents. Theta. Theta is the most important thing when you're buying options. When you're selling them, it can be seen as in your favor. When you're buying them, not so much. As this diagram shows right here, theta is at -7 cents. What this means is that your contract each day loses 7 cents of time value. That's basically what theta is, time value. Vega is completely unimportant for those beginners because you're not going to be dealing anything with Vega. You're not that smart yet. Again, the most important thing here, okay, is the bid-ask. The bid-ask ends up being what you're buying. So if we want to be selling this contract at the 190 strike, we are going to click on the bid. Again, this will bring up a sell window where we'll be added to where we'll be asked to enter the selling details. Ask. This is what you click if you want to be buying the option contract you purchase. Again, some of you don't know what this means. A 21 cents if you're buying 100 contracts, that's $210. Again, this is $300, 30 cents a contract. So, what does it mean to be in the money or out of the money? Well, to be in the money, as seen here through these shaded regions right here, the in the money options have the most intrinsic value, which means they're actually worth something. The options out of the money don't really have anything, and they're made up of time value, known as extrinsic value. So why not just buy in the money options and then profit over time? Because that goes against the sole purpose on why options were created in the first place. Options were created in the first place to provide cheap leverage to the people who couldn't afford to buy stock to make substantial profits. Moving on, because I'm running out of time here, okay? Again, we have the expiration. It's going to be the same, October 14. The strike, the different things you will be purchasing the stock at. One thing about the strike, the further out the strike is, the cheaper the price, the option is going to be, as seen here. $1,000, $900, $520, and $300 as they descend through the strike prices. Okay. Just one more quick thing here. I will be making a part 2 of this video because we are running out of time. So, delta. As you may have noticed, the call delta is positive and the put delta is negative. So right now, 2 strikes out has a 29 delta, and 2 strikes out on the calls has a 12 delta. So let's take a quick look at the profits we will make if we bought this option contract. The order window pops up, and we will be buying a single 10 contracts of the Goldman Sachs. That's the strike price. It's a put. The price we're not going to be fiddling with because you're not there yet. It's a day force. Now, because this denomination's in 10 and it's at a 179 strike, 182.5 strike, sorry, we will be making $181,520 profit with this purchase. That is the break even. So a lot of people will ask, well, why is that possible? Because it's in denominations of 10. This ends it for Series 1 of the Goldman Sachs. Join me for Series 2 in a few minutes. Bye.